So this is nuts. And this isn't clickbait. This isn't, oh my God, it's no, really. This article was written in 1999. This was the year that I was born. We like to really commend history around here at this channel. History doesn't always repeat itself, but it surely rhymes, as famously quoted by Samuel Clemens, aka Mark Twain. This is unconfirmed. This is I'm about to dig into this. I believe this company was actually bought out by Citadel, by the way, in 2012 when one of their proprietary trading algorithms went nuts just out of the blue and sunk the company by 50%. And then an oh so convenient injection of capital came along by your boy Kenny. So 1999. Online traders may not know what their orders to brokers such as E-Trade and Ameritrade get passed along to Knight/Trimark's computerized trade stations in Jersey City, New Jersey, but in barely 4 years. So this goes all the way back to 95. But in barely 4 years, Knight/Trimark has become the world's largest market maker, handling the orders of heavily advertised brokers like E-Trade and Discover Brokerage Direct. As those brokers have grown, so has Knight/Trimark. It's a lot like the relationship between online retailers and FedEx. Pause. Replace FedEx with Amazon. Many of the internet's businesses have yet to show profits. Did someone say unrealistic PE ratios? Not so with Knight. The firm has made lush profits, and its stock has shot from an October of '98 price at $4 to $64, and more recently has been trading at about $40. Blah 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 blah. You can dig into this more if you want. This just dives into their earnings and how decadent some of these. It's ridiculous. Here's where it gets interesting. As the Wall Street face of seemingly mad online investors, you tell me what some of these words should be replaced with in modern times. As the Wall Street face of seemingly mad online investors, Pasternack's firm makes some traditional brokers mad. Pasternack is a part owner of Knight/Trimark. Not only has Knight garnered 15% of all trading volume on the NASDAQ stock market, and I think this was before the NYSE had become the NYSE. This was actually when the NYSE was technically a dark pool. It wasn't a public exchange. Blowing past market makers like Charles Schwab's MASH Institutional or Herzog Hingeduld. What? Okay. But investment bankers blame Knight/Trimark for disorderly and delayed opening trades in many recent new issues. With crammed queues of online customers ready to pay any market price to get new .com stocks, Knight/Trimark has snarled trading in ways that suggest to some brokers that the firm is enriching itself at other people's expense, including its own customers. This is 1999, by the way. Again, this was the year I was born that this was written and published. That's pure poppycock. I don't know why that was considered an okay thing. The 90s were really strange. Blah, 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 blah. Actually, no, this is actually a great part. The opening day crush for new issues is an industry problem, he says, plaguing all traders. Knight and similar market makers are just processing transactions for individual investors who think internet stocks are worth more than what Wall Street pros do. That is quoted by the owner, part owner, whatever the relationship is or was at the time, of Knight/Trimark. What would you replace that with in modern day terms? Knight itself was founded by Wall Street pros like Pasternack, who came aboard in 1995 from the Troster Singer unit of trading firm Spear, Leeds, and Kellogg, after concluding that old line market makers like Troster were falling behind the changing markets. Knight set up shop as a partnership of more than 25 brokers, including E-Trade, Morgan Stanley's Discover unit, and the Waterhouse Investors Services unit of Toronto Dominion Bank. Knight jump-started its order flow by paying rebates to its broker owners. Please try to tell me we haven't heard this one before. Again, this was 1999. Indeed, Knight's trading volume doubled in 1998 to 38 billion shares of stock on 41 million trades, up from 20 million trades in 97. Now this is where it gets juicy. Market makers like Knight are invisible to the investor who calls a stockbroker or sends a message to Ameritrade's computers. But such stockbrokers usually turn around and give the order to market makers. Through a network of NASDAQ computer screens, market makers post the price at which they'll buy and sell a stock, often using their own capital to take the other side of an investor's trade, holding the shares in inventory while finding another investor. I'll clarify this later. This doesn't exactly mean that buy orders are clogged by 36 days or whatever. It doesn't rule it out, but it also doesn't guarantee it, so I want to make that clear. Although electronic communications networks, ECNs, like Reuters Group's Instinet or the Brass utility bought last week by SunGard Data Systems, now match about 20% of NASDAQ trades without a market maker's mediation. Most electronic communication networks don't risk their own capital to facilitate trades. While an investor may languish waiting to match a trade on Brass utility, a market maker like Knight might take the trade immediately using its own dough until the appropriate buyer or seller comes along. 1999, by the way. Market making was an easier road to profits when there was a big spread between the prices that market makers bid and asked for a stock. After buying a share for $20, for example, the market maker often could sell it immediately for $20.75 and pocket the spread, 75 cents. But a 1994 study by economists William G. Christie and Paul H. Schultz said the absence of odd fraction quotes by NASDAQ market makers suggested that spreads were governed not by competition but by collusion. Let's say that one more time. This was in 1994 that this study was done. William G. Christie and Paul H. Schultz concluded that the absence of odd fraction quotes by NASDAQ market makers suggested that spreads were governed not by competition, but by collusion. In 1996, the Justice Department and the Securities and Exchange Commission obtained a settlement from the National Association of Securities Dealers to end this casino skimming racket. Subsequent SEC rules have cut in half most market maker spreads and profits. Lately, the New York Stock Exchange and even the NASD, I'm not sure what that is, itself have chatted with electronic communications networks about teaming up to compete with traditional market makers. Hey, Charlie. Please talk about this. There have been tons of filings coming from the NYSE and even a quote from the president of the NYSE about 4 months ago going on record and saying that they can't compete with payment for order flow, which is exactly what this is talking about without the term. The payment for order flow was not a trading floor term, like a household term, but for trading floors. So you get the point. Into this changing environment was born Knight/Trimark's predecessor, Roundtable Partners, in 1994. Even after a July 98 initial public offering of stock and the recent secondary, Knight's brokerage firm founders still control about a third of the firm. But given Knight/Trimark's steady profit growth, public investors have been only too happy to get their hands on the firm's shares. This just goes into more numbers on revenue and earnings. Driving Knight's trading volume is the general growth in trading of NASDAQ shares, which has tripled in the past 5 years. In particular, the firm has benefited from the rise of online trading, which is climbing at a rate of 25% a year. Happily for the firm, market research by the likes of Forrester Research shows that the average online trader engages in 5 times the number of trades as a traditional individual investor. Pastor Nick also credits his firm's success to speedy execution of trades. In all, Knight makes a market in 6,000 NASDAQ stocks, automating most trades with computers. The Trimark piece of the business has become a leading market maker in off-exchange trading of stocks listed on the NYSE and exchanges alike, a business previously led by firms like Bernard L. Madoff. Biggums? 1999. I'm gonna skip over this. I'll do this one. But with the sure profits of spread trading now bygone, market makers like Knight/Trimark are increasingly trying to make a buck taking short-term positions in their stocks, whether long or short. To manage the risk of such proprietary trades or trading, firms like Knight limit their exposure to any specific stock with automated alarms and the oversight of experienced trading managers. Still, Knight/TriMark had between $73 million and $200 million riding on its long and short positions. At the end of various months in '98, the firms long and short offset each other in the aggregate. So the net month-end exposure ranged from $39 million long to $56 million short. Imagine what an automated trading system would do if it saw a bunch of heavily shorted stocks with an environment suggesting that there would be even more market turmoil. And I can guarantee you some of these algorithms and analysis platforms check fundamentals. So if you see failing balance sheets, and let's just imagine in nowadays terms what this would equate to. But as internet stocks went nuts in the 1998 fourth quarter, many investors fear that $20 moves in stocks like Yahoo might catch Knight/TriMark at the wrong end of more proprietary trades. Pasternak says the recent trading volumes and price volatility of internet stocks has made losing days a little more frequent but allowed bigger gains on the winning days. Quote, we are right about 50%, 60% of the time, every time, says the chief executive, and wrong about 40 to 50%. So 10 to 20%, right? To the great joy of investors, Knight/TriMark had record. Yeah. Here's where I almost lost my shit. A little background. This was considered a stand-up metric back in the day. Knight's volume has continued to grow since December, says Pasternak, and the firm has handled more than 400,000 trades in just one day. 400,000. I think Citadel's is like 30 million a day, somewhere along the lines of that. We're all dismayed, or this is a quote, we're all dismayed at the ways of these IPOs trades, said the chief financial officer of a recent new issue. Even though you close up 100% of the pricing, or from the pricing, you have had a bad feeling about it. Knight's Pasternak says bankers single out his firm because it has the strongest association with online investment demand. In hot internet deals like theglobe.com and marketplace.com, online demand from investors far outstripped the expectations of investment bankers. There's been a, quote, major disconnect, Pasternak says, between the price investment bankers think such shares deserve and the price the public is willing to pay. Pasternak sat on an industry committee that looked for solutions to such public buying panics, but the committee adjourned without agreeing on a solution, and evidently still haven't agreed on a solution 22 plus years later. One investment banker who doesn't blame Knight says that the market makers are just conduits for amateur investors who bid unrealistic prices. The recklessness of such investors, says this old Wall Street hand, is, quote, like people driving a car who have no automobile license. But another investment banker says he can't think of another market maker that crosses markets with high bids as frequently as Knight. He grumbles, quote, no one is as blatant as they are. The rub, of course, is that the wildly fluctuating stock price gives market makers the opportunity to make more money because of the spreads. Several traders noted that online clients of firms like Knight/TriMark often place so-called, quote, market orders for hot IPOs. Parallels, people, parallels. Giving the market maker freedom to fill the order at whatever price the market bears. Those traders speculated that crossed markets might result from a market maker filling its clients' orders at a high bid price with its own short sales, then profitably covering the short sales at the lower prices offered by clients of the underwriter. Without inspecting the market maker's books, however, outsiders can't tell if it's making such proprietary profits at the expense of clients. This right here, this next quote is where I almost lost my shit. The Knight chief executive says his firm has encouraged customers to use limit orders to set price ceilings on their IPO orders. That was also the advice of the SEC chairman Arthur Levitt in a special January 27th message to online investors. January 27th of 1999. the last thing I want to go over is a strategy used by anyone who's issuing an IPO and market makers alike, known as the green shoe. I'm going to make a different video about this because I just realized this is going into over 15 minutes. Things are getting interesting. Things are getting very, very, very fucking interesting.